Good afternoon. We're going to be starting in just a couple of minutes as we're going to let people sort of gather for a minute. So good afternoon. I see people are joining us. We're just going to wait just a minute to give folks a chance to gather. You know, I don't see anybody new coming in. I'm just going to go ahead and start, and we'll if anybody else joins us, they'll have to catch up. So good afternoon. I'm Bob Faulkner. I'm president of the Community Foundation of Greater Memphis. And welcome to our annual investment review. This is something we try to do annually, just so that everybody knows kind of what's going on in the markets and what we're doing on the investment side. You know, from day one, the investment of our donors' funds has been a primary concern. Our mission is to protect and to grow those funds to maintain and to increase charitable giving in our community. So, we spend quite a lot of time during the year thinking through our investment strategies, consulting with our advisors, and reviewing what's going on in the world, really. Overall, our historic returns have been strong, and based on our longer-term track record, nonprofit organizations like those that many of you represent started to approach us almost 30 years ago now, asking if they could invest side by side with us. They wanted to take advantage of our experience and success, but also the investment diversification and fee savings that went along with investing as a part of a large asset base. Since that time, we've attracted over 100 nonprofit funds, currently totaling about $75 million. So, we really appreciate your faith in us. And as I said, we take very seriously the responsibility in managing your funds. The financial life of your organizations is closely tied to the preservation and growth of those funds. And, we view that as an important part of our service to this community. What we'd like to do today is let you hear from our investment consultants, Prime Buchholz. We hired Prime Buchholz last summer after an extensive national search. As you'll hear, Prime Buchholz brings to us their considerable expertise and experience, including uniquely quite a lot of experience with community foundations, which was really important to us during the search. We're already very pleased with the new directions that Prime Buchholz is taking. You'll hear a lot about that today as they'll discuss their views on the markets and their particular perspectives on each of our investment pools, how they're constructed, and how we're adjusting each of them in today's challenging economic environment. But while the primary voice you'll hear is Prime Buchholz's, I need to make sure that you know that they are advisors and consultants. The actual investment decisions are ours. They're made by our own investment committee, a group of financial professionals, and I hope that's them. A group of financial professionals drawn from throughout our community. The committee includes individuals with specific knowledge and experience in the full range of investment products, including stocks and bonds, real estate, private equity, and alternative investments. They include seasoned money managers and financial professionals. So these are the people that actually make the tough decisions. They rely heavily on Prime Buchholz's expertise, but they're free to deviate from that advice whenever they deem it appropriate to do so. They haven't done that yet. We've certainly stayed very close to the line that Prime Buchholz has shown us, but in our past experience with prior investment consultants, they certainly have felt free to deviate when they thought it was appropriate. Our committee, like many of you, I'm sure, has been unhappy or uncomfortable, I guess, with the performance of the balanced active pool at times. We've been managing the balanced active pool since 1995, and with assets of over $200 million today, it is by far our largest and most popular investment choice for donors and our nonprofit partners. Since its inception in 1995, the balanced active pool has outperformed its indices, providing outstanding returns and extraordinary diversification. Although since the market crash in 2008, the balanced active pool's returns have been a little volatile. They've certainly struggled a little bit. With Prime Buchholz's guidance, the investment committee has begun to make some significant changes to the asset and manager mix in the balanced active pool. Because of its size and popularity, a significant portion of our focus today will be there. But that's just one of our 9 investment options. Our presentation will touch on all of them, and of course, we'll leave plenty of time for your questions. So we'll be monitoring the chat function, by the way, so particularly for your questions. So if you have any questions along the way, please add them to the chat function. We've got people standing by to monitor that, and we'll cut in if we need to, or we may hold them to the end depending on what the specific questions are. But we'll try to leave plenty of time to answer any questions that you might have. All right, so let's go ahead and get started. Kathy Powers, principal with Prime Buchholz. I think I'm going to pass it to you.
Great. Thank you, Bob, and good afternoon, everyone. So I will pick it up here in terms of just a brief update on Prime Buchholz. And then, as Bob mentioned, we'll focus on the investment options and more specifically, a deeper dive on the balanced active pool. So with that in mind, just a brief update on Prime Buchholz. As you see here, we've been advising clients over 3 decades. We are headquartered in Portsmouth, New Hampshire, and have growing offices actually in Boston and Atlanta. We're today at a size of $75 billion with 250 plus clients. And if I had to pick one point on this page for you to remember about Prime Buchholz, it's that we are independent and 100% employee owned. And our independence is extremely important to us in terms of really ensuring that our interests are aligned with our clients. And today, over just about 1/3, I should say, of our employees are also owners in the firm. And that has been expanding a lot, particularly over the last 5 years. And it's something we expect to continue to see ownership across employees, departments, up and down the organization over time. So this is an important part of our culture as we move forward. As you think about our clients, this obviously is a list we are very proud of. Community foundations today represent over $6 billion of our assets under advisement and an important part of our overall business. Nonprofits represent the majority of what we do. About a little over 85% of everything we do is with nonprofits. And of course, as you look down this list, our community foundation work regionally is diversified, by asset size it's diversified, and importantly, as we work with Greater Memphis, we certainly want to share the experiences and the best practices across community foundations with you. So this is an important part of our overall business and the community foundations that we serve. We're very happy to have you as part of that family. If you turn to the team, and I think the point here in terms of the resources we have to serve the Community Foundation of Greater Memphis, you can think of this investment office as really an extension of the investment committee that Bob described, because there are certainly resources across the team. In addition to the consultants, we have investment analysts and performance analysts focused on helping with everything we do on our recommendations, tracking your investments, customizing the reporting, and the back office support we provide with our operations team. There's also the access we provide to our research team. We publish white papers on the market. And as I mentioned earlier, the work we do with other community foundation clients is something that we bring to the table as we work with Greater Memphis. Now, another way you can think about it is in the partnership we have with the foundation. And what we're illustrating here are the various ways that we collaborate with the investment committee. As Bob mentioned, the committee retains the decision authority when it comes to the recommendations that Prime Buchholz is making. And so what we're laying out for you here is how that works in terms of the recommendations we propose as it relates to the asset allocation and the investment policy, which is obviously an important part of the work that we do. And the committee is our sounding board, if you will, in terms of vetting the proposals and ultimately, if they agree, approving the asset allocation targets and ranges and formalizing that in the investment policy statement. From there, we move to the implementation as it relates to selecting the various managers. And here again, Prime Buchholz will be making proposals on the implementation. And that can mean picking the managers, what we recommend, active managers versus passive, managing the fees related to the selection of who we hire, as well as the liquidity terms. And all of that goes into consideration when we make these proposals to the investment committee. Again, with their approval, we then move towards the trade activity and providing support for the committee and the foundation, I should say, to execute those trades. And then last but not least, it's the risk management and the reporting and meetings that we have with Greater Memphis. So in this area, we are providing the monthly and quarterly reporting. We have an online portal now that our clients can also access all the information that we look at on our end as well. We are certainly monitoring the managers and the exposures, performance, providing attribution, and bringing that all to the investment committee at the very least on a quarterly basis. But when markets are volatile, we certainly are open to any ad hoc meetings as they may be needed. And then, of course, the rebalancing as we move through market cycles and the meetings, we bring forth any recommendations as it relates to rebalancing the portfolio back to the strategic targets. And again, here the investment committee has the final say on where that lands. Now, as Bob mentioned, as you think about this partnership, I think a good way to reflect upon it is the various investment options that are available. And while there's a lot of detail on the next 3 slides, I'll just walk you through what you're seeing here are the returns for the period ending March 31st. You can see here, these are the active pools, the balanced active, which we will focus and do a deeper dive with you on this. The equity active pool, which many of the steps that you'll hear Brian and I talk about in the context of the balanced active pool can flow through to the equity active and the fixed income active pools. As you look to the bottom table, by the way, you can see we've listed for you the benchmarks for each of these investment options, as well as the different period returns and since inception. So you can take a look at the history of each of the pools. Clearly, some of them have shorter time periods than others, so it's not exactly one that you can compare to the next, but it will give you a good sense of what each of these pools and respective asset classes have provided over time. And importantly, we'll maybe, if you jump to the next here, fixed income slide, again, what we'll be talking about in more detail on the balanced active pool can flow through to the fixed income active pool. and have some relevance for the other options as we go through this presentation. So there's a lot of detail on these slides, but it was really intended to highlight there are a significant number of options for you to choose from, and all of them customized as well as differentiated between active and passive. So with that, I'd like to turn it over to Brian, and he'll be beginning this discussion, taking you through some of our recent actions, our priorities, and doing a deeper dive, as I said, on the balanced active pool.
Well, great. Thank you, Kathy. Great to be with you all today. Really excited about the progress that we've made with the investment committee since being engaged just under 12 months ago now. It was July 1st that we formally began working together, and it's been a busy nearly 1-year time period here. We really started our efforts the last couple of quarters of last year together, really understanding the return objectives, the risk tolerance, the spending, liquidity needs of the organization, and from there, really crafting the long-term asset allocation approach. One of the biggest decisions that we made in partnership with the committee together was to reduce our emphasis on fixed income. So we lowered our policy target to that category from 35% to 25%. The offset has been an increase into equities, both public and private equities. We feel really good about that shift in approach there. We think we can really take advantage of higher returning forward-looking prospects from equities. So we've adopted the new policy targets here, and then we've been gradually moving the portfolio, repositioning the portfolio towards these new targets over the subsequent months here and into the new year. And when you look at the portfolio, sort of the next layer of increasing the equity targets, but within the equity categories as well, we've shifted our exposures from a regional perspective, more emphasis on the US, less of an emphasis outside of the US within the equity categories as well. We talk about reducing the reliance on small cap stocks to a degree on some of our active exposures in the portfolio. So we think on the margin, these are maybe not major shifts, but we think these are important and impactful shifts that are going to reduce the overall cost of the structure, take out some of the complexity and some of the tracking error. And those changes have been completed or are in progress to be completed in the next couple of weeks here. As we look ahead for the balance of the year. So again, we feel really good about the changes and excited about the progress that we've made. We want to continue to build on that momentum, continue to have discussions about asset allocation that we started with the committee last year, potentially considering an allocation to hedge funds for some of the diversification benefits that structure may provide to the balanced active pool. We're spending some time considering our real asset implementation and if there are options to improve some of the inflation hedging characteristics in that category. Private equity, as I said, we've adopted a 10% target here. We think that's a really big opportunity for the balanced active pool to really grow and magnify our returns there. We'll be looking to execute on a couple of manager decisions in the coming months, and then really over the balance of the year, staying on top of the IPS, making sure that it's updated regularly and reflects best practices there. ESG, DEI, ESG, environmental, social, and governance considerations, DEI, diversity, equity, and inclusion, really monitoring our portfolio exposures there and looking for ways to enhance those metrics without sacrificing returns. Going back to that asset allocation, that starting framework, again, what drove us to the decision to move more in favor of equities, really having a bigger allocation to that growth engine in the portfolio here. We think that in order to achieve the rates of return that we're looking to achieve, inflation plus spending, that we do need to take on some equity risk, but we want to protect that growth engine and those equity exposures with hedges. in the form of high quality fixed income, providing liquidity, providing that equity market dislocation, deflation hedge. We talked about the inflation hedge that we have in place here, some of our real asset exposure there, providing some return diversification benefits and that hedge against rising inflation. And then potentially other hedges in the form of flexible capital, the dislocation hedge, the dollar hedge as well. I think that's all potentially part of this solution of this all-weather diversified approach here that's going to improve our odds of consistently meeting our return objectives. We go a little bit more granular, a little bit more focused to the Community Foundation, the Balanced Active Pool here, showing you the long-term policy targets that were established. Again, 57.5% to global public equity. We're diversified across regions, although we do have an emphasis on the US market, on the home market there. Private equity, again, we think a really compelling opportunity for the Balanced Active Pool, some of the highest return seeking categories across the capital markets, venture capital, buyout, growth equity, potentially some distressed and opportunistic credit could fall into there as well. Real assets in the form of real estate, and then of course core bond, where we have that, again, that downside protection, that liquidity valve, that true portfolio insurance element. We have that in the structure as well. Just quickly touching on, again, the guiding principles here, as Kathy mentioned, really long-term strategic approach here. We're not trying to time the markets. We're not trying to make dramatic shifts quarter to quarter. We do believe in the power of rebalancing and taking advantage of opportunities as the market presents those and give us opportunities to rebalance back to targets, to buy equities when there are declines in the market, and really keep our overall strategic positioning in place. And we think that's the way long-term that we're going to achieve the types of returns that we're seeking here. That CPI, call it inflation plus spending of 4%, achieve a rate of return that hopefully is in excess of that 60-40 benchmark here. We've shown you the longer term numbers, as Bob said, really good track record, strong history going back to the mid 1990s of achieving those results. And we think with some of the changes that we've enacted in partnership with the foundation and the committee, will improve our probability of achieving those going forward. Certainly the CPI part of that, CPI plus 4, has gotten a lot harder to hit over the near term. So you'll see there is a little bit of a shortfall over the 1 year, but longer term still able to keep pace and to exceed that benchmark. We've got great flexibility in the portfolio today, really strong liquidity profile. About 85% of the portfolio has daily liquidity, so that gives us a lot of flexibility to move opportunistically. Just a couple comments. I touched on these already, but just to put some numbers around some of the changes that we've made within the public equity category. When we started working together just over a year ago on a look-through basis, when we sort of rounded up all of your public equity exposures and looked through every individual fund and separate account, classified those stocks into the various domiciles where they're located, we had about 50% exposure to the US, and that compares to the MSCI All Country World Index, which has approaching a 60% weight there. And so that was one of our first shifts that we made in conjunction with the move towards increasing our equity allocation, was within equities, increasing our US exposure. When we think about the types of companies in the US, some of the most dynamic, most world-class companies in the world that have global revenue streams. And so we think it's appropriate, we think it's prudent for the Community Foundation to have at least that market exposure to the US. And so we've made progress there, where we're essentially at a 60% weight to the US. And we think there's a role in the portfolio for non-US, for emerging markets. We want to maintain some exposure there, but certainly not at the expense of the US. And so you see how we've shifted those regional weights over the last nearly 12 months here. similar project as we've been reducing our non-US emerging market exposure. We've been taking steps to take some of the small cap orientation out of the structure. So the green bar represents where the portfolio was when we started working together. About 25% of our exposure within public equities was to small cap companies, companies that have a market cap of less than 5 billion. We've really rotated that down in favor of some of the larger, the mega cap companies. So, less of an underweight to the Apples, to the Amazons, to the Googles of the world. We've made some real progress here, and the goal being to take some of the, again, the structural biases, the underweight to the US, some of the overweight to small cap to value stocks. They don't seem like maybe major changes on the surface, but we think that these are important. We think that these are impactful, and these combination of small changes can lead to big differences in the return outcomes. And then finally, I've touched on private equity a couple times. Again, we think it's a really compelling opportunity for the foundation for the long-term potential returns here. We think if we construct the program appropriately, that we can generate returns that are in excess of the public markets. It's an immense opportunity set when you look across the number of companies that are private or staying private longer in the US. We think through that dedicated research team that Kathy alluded to earlier, we have access to the very top managers in the space here, and we can build a really compelling portfolio for the community foundation, build towards that 10% target, and build a structure that's really disciplined and has great exposure across vintage years, across strategy types, to really execute and really drive that cash generation, that return generation for the balanced active pool. I'll turn it back to you, Kathy.
Great, thanks. So I'll switch gears here and give you an update on the fixed income and real asset segments of the portfolio. And I'll just start by saying that it's been obviously a very difficult environment for bonds. So we're in a period, as we saw at the end of last year and certainly into 2022, where the risk, and I should say the inflation outlook and the realized inflation we are seeing has caused the Federal Reserve to shift their policy significantly tighter. And the market has reacted by pricing in much higher yields than we've seen in a long time. And on that front, some of the observations and considerations for the portfolio as we work through the rest of this year are really what you're looking at here. First and foremost is the fact that the fixed income segment of the portfolio has had a shorter interest rate duration, and that obviously has helped as yields have risen as much as they have. At least at the end of March, and they're higher into April, yields still have a 2% handle, which, as Brian alluded to, with inflation running as high as it is, it still is difficult for bonds to meet that return objective of spending plus inflation. So from an asset class standpoint, there's still an expected shortfall when it comes to returns. And then as we drill down and look at the composition of the fixed income segment, there is not much exposure at all to treasuries, which hasn't been a problem as yields have risen, but in more normal times than what we're experiencing right now, treasuries do provide the best downside protection. And so that is something we're thinking about going forward, particularly as yields have risen. And that sort of ties to the last point on the strategies today are very much focused on using sectors and the extra yield over treasuries to earn the return. And so that emphasis is something that might transition a bit as we look ahead. So if I tie that to the considerations, there's a couple of key points here. As Brian mentioned, 25% is the target allocation today, but given the asset class is still somewhat expensive relative to the return objectives, it's potential that we could look at changing the allocation slightly from here. And that would really tie to also the rebalancing of the duration in the allocation, and certainly yields being much higher today. We can start thinking about taking advantage of the higher yield environment that we're in. And the quality hedge is really referencing the fact that we don't have much exposure at all to US Treasuries, which in, again, more normal times give you the best downside protection. We could also look at inflation protected securities as part of the fixed income allocation. And I'll tie that with our discussion on real assets in just a moment. And then, of course, we should expect that there will be periods of volatility and spread widening that we'll want to take advantage of. So thinking about some of the strategies to take advantage of dislocations in the future could be part of the overall transition within the fixed income segment. All of this, we think, potentially improves the return profile of the portfolio, reduces risk. If we rebalance duration, we can lower the tracking error to the broad fixed income market. And thinking about treasuries, perhaps some better downside protection and active strategies to add the potential excess return over time. So with the fixed income market, the next slide really depicts the challenges we've seen for bonds. And these challenges for bonds as it relates to inflation have really been, real assets, I should say, have been the beneficiary of all this inflation. And so what you see here very simply is the year-over-year percentage change in the consumer price index. And of course, as you look at the post-COVID reopening surge in demand, and then of course, with the Russia and Ukraine situation, the compounding of inflation with the rise in energy prices, we are most recently at that 8% year-over-year level, and certainly have not seen this type of inflation, if you will, since the late 70s and early 80s periods. So this is top of mind. Inflation is a topic that many of our clients are, certainly thinking about when it comes to their portfolio and their asset allocation, which really brings me to the real asset overview that you see here. And similar to the layout for fixed income, we have some observations and considerations and a little bit of a deeper dive into the composition potentially for real assets. And today, the portfolio, the good news is, has a 7.5% dedicated target to real assets. And that is today in US real estate. There's a small legacy position in a private real estate fund. But as we think ahead, particularly given the fact that inflation, given how high it is today, may take some time for it to come back down anywhere near the Fed's 2% target. So as we think about the composition over the next several years for the foundation's real asset allocation, we are considering diversification so that we get more benefit from inflation sensitivity to CPI, as well as return potential. So those are two important components. As you look at this bottom table here, we try to lay that out for you in a little bit more detail. So as you think about tips, which I mentioned have obviously fixed income attributes, tips and commodities tend to be directly linked, if you will, to inflation, and therefore have some good, stronger diversification benefits when it comes to inflation sensitivity, but they also historically have had lower returns. And if you look to move to the right and consider natural resources and real estate, here the returns tend to have a higher beta, if you will, to the equity markets more broadly, a little less direct, more indirect, if you will, inflation protection, and therefore their diversification benefits can be less than what you get from tips and commodities. But ultimately, the reason we like a diversified approach is you get the best of all of these various segments within real assets, and the potential benefit to the asset allocation in the foundation's portfolio is that we think we can improve the inflation protection, add some incremental sources of return with this diversification, and also take advantage of some active managers within this area of your portfolio as well. So we think it ties together nicely in terms of probably the next phase for where we're looking at some changes in the composition of the portfolio. So with that in mind, that covers the various segments in your portfolio. And we'd like to perhaps summarize all of it with a couple of thoughts on the market and then how the foundation's portfolio is positioned based on our outlook. So with that in mind, the next few slides that I'll be covering, this is very simply a summary of the asset class returns. And I think if you focus your attention on the blue bars, the year-to-date returns through the end of March, you can see with the exception of commodities and natural resources, it has been a difficult period for stocks and bonds and hedge funds. And with the exception of some of the real assets in the commodities and natural resources, more specifically, where we've seen the benefit of much higher energy prices. So messaging here is with inflation being what it is, there's some headwinds still, particularly as you focus your attention on bonds. You can also see this as you look at the domestic equity sector performance. And on the next slide, again, focusing your attention on the year-to-date blue bars, this just really highlights the dispersion of the returns across the various sectors. So when you think about the really exceptional returns we're seeing in energy, and that has continued into April, and you contrast that with other areas, particularly growth industries like technology and communication services, they have been hard hit this year by the headwinds, particularly from higher interest rates as their earnings have been discounted at much higher yield. So it's been, the messaging here is it's not just been a difficult environment, but there's a lot of dispersion as you look underneath within the equity markets. You can see this on the next slide too, the movement up in yields. And I mentioned this has continued into April. There's just been a tremendous pivot from 2021 into 2022 as we think about the Fed pulling forward and increasing the level of interest rate hikes in response to what has been exceptionally higher inflation. And what's important here as well is the flat yield curve we're seeing. Briefly in March, we saw the yield curve invert. So that's an important indicator, if you will, that we are watching. But the level that you see here of higher interest rates in the flat curve just really reflects how fast things have changed in the first 3 months of the year because of the inflation backdrop. And you see this also on the next slide with inflation expectations. And what this is showing you here is that as we came out of the COVID and the brief recession there, inflation expectations picked up as the economy reopened. But where we've landed today, and this is showing you the difference between nominal 5 and 10-year treasuries and the real yield in 5 and 10-year maturities. So the blue and the yellow lines are decently above the Fed's 2% inflation target, But what's interesting is when you look at the 5-year inflation expected 5 years from now, you can see that while it has risen and it is above the Fed's 2% mark, it's more anchored, if you will, relative to the market pricing that we're seeing in tips. And this is simply just an important reflection when you think about the fact that part of the Fed's job, obviously, is to keep inflation expectations anchored so that they can manage the level and certainly the financial conditions side of the market as well. And then the last comment I'll make on the market is what you see here. And I mentioned briefly the inversion in March. And so as you look back on history, when the yield curve has inverted, it has been a good leading indicator of recessions. And so today, and in particular in April, we've seen a re-steepening, a mild, but a bit of a re-steepening in the yield curve as inflation has risen. We had a recent report update in the month of April for inflation, and you saw the 8% level we're experiencing. And that did essentially cause more of a backup in 10 and 10-year yields and beyond relative to the front end of the curve. And this is also part of the situation here is that the Fed is expected to be raising interest rates as the growth outlook recedes. So there's a bit of a challenge here in terms of the Fed's job and maneuvering to keep raising rates as the growth outlook perhaps softens a bit. And so with that backdrop, really the summary or the key themes to our outlook here, as you see, is obviously inflation is top of mind. The risks are elevated. As I mentioned, inflation has been compounded by the spike in energy prices as a result of the war between Russia and Ukraine. And that's on top of the supply disruptions we already were experiencing as the economy reopened. And we certainly have a tight labor market here in the US. What's really interesting is the reaction across central banks, particularly as you think about the Bank of England already raising rates along with the Fed. And importantly, the ECB is expected to be raising rates before the end of the year, which is really a dramatic shift in European policy going from negative rates. So tightening is an important shift to be watching there, at least from the market's expectations. And all of this really is the uncertainty on where we land and whether or not central banks can navigate such that we have a soft landing, or is the tightening to the extent that it is being pulled forward and there is an increase in rate expectations such that we have a deeper downturn and a possible recession on the horizon. And this is all summarized in our positioning, and Brian spoke to the equity side. Both public and private equities are representing about 2/3 of the assets. And this is a strategic positioning for us. So we appreciate that it's hard to predict how markets will recover from here. I should say the timing of that. So we take a long-term view and believe very much so that the expected returns from the public and private equities will be the source of growth for the portfolio going forward. And we continue to work to build up that private investment part of your portfolio, as that is one of the areas where we are seeing very attractive returns on your existing program, as well as what we expect going forward over the longer term. I spoke a bit about the real asset and potential to diversify there, but strategically, we see this as an important part of the portfolio, given the potential for inflation to be running above the Fed's 2% target for an extended period. And then finally, when it comes to fixed income, Clearly, there are headwinds that remain in terms of increasing interest rates, but a lot of that has been priced into the bond market as we speak. Of course, inflation may be slower to come down off its elevated level, and that could continue to be the headwind for bonds. But yields are certainly a lot more attractive than they've been since COVID. And so we can and will continue to consider rebalancing duration and the sector exposures in the fixed income segment. And Brian also mentioned the portfolio has really strong liquidity to facilitate rebalancing as we think across some of these changes in the various asset classes in your portfolio. So with that, perhaps Brian, do you want to just quickly recap anything on our portal before we open it up further?
Yeah, thanks, Kathy. And we alluded to this, but this portal, the Prime Plus portal, is a really just powerful tool. Kathy, myself, the entire team for the Community Foundation, we use, again, this is a great source of data for some of the exhibits that we showed you earlier in terms of our regional exposures and across our equity categories, capitalization as well. Really powerful for just sort of keeping tabs on the portfolio, returns in these volatile market environments, being sure that we're in line with our asset allocation, really great manager data attribution, ESG, environmental social governance information as well. So it's a tool for Kathy, myself, the team, and also for the Community Foundation as well. The investment committee, the management, to keep tabs on the portfolio and the exposure. So, just wanted to highlight this item.
And I can thank you, Brian. There were some slides I'll just mention in the materials if there are questions. I know Brian mentioned earlier ESG and diversity, equity, and inclusion, and we're happy to address any of those areas as it relates to the foundation's portfolio, so we can reference back to them as needed.
Great. I think Bob and George, if you want to turn your cameras back on. We've only had one question in the chat, and I think it's probably more Community Foundation focused.
Yeah.
From a smaller organization, a new organization with a small amount in their fund here and a low risk tolerance. We have recommendations on how much we should have in cash versus other investments.
Yeah, and let me address that. And that actually, particularly talking to our nonprofit partners, is one of the most important conversations that we have. We have 9 investment options ranging from cash equivalent, basically risk-free cash options, all the way to complete equity exposures. The largest pool is our balanced active pool, which is a blend of stocks, bonds, and real investments. The specific answer I'll say is we'd be happy to sit down with you to talk with you and your leaders of your board and staff, to talk about your specific situations. But I think for the broader group, I think it's important to say that it depends on your agency's projected use of funds. If you think you're going to be using funds or need to draw funds out for reserves or for building a project or something, then certainly you would want to not have those at risk in the overall markets. So to the extent that if you have X dollars in there and you want a third of it that you'll likely be using, then I would consider putting a third of it in probably risk-free assets. To the extent that you're putting the money into the market for the long term, for growth and so forth, then I think as much as all of it could be exposed to something like a balanced approach. But again, it depends on your risk tolerance and your projected use of funds, and we're happy to talk to you, Robert, and anybody else on the call about those things. I'll say also that we do like to meet periodically with all of our nonprofit partners, so that there aren't any surprises about where you are and the returns in the pools. Particularly, as the markets jump around, your board tends to say, hey, what's going on with our investments there? And we're happy to, we would prefer to sit down with you and meet with you so that there aren't any surprises there.
Are there any other questions?
Everybody's pretty reticent because, and part of it is we've been very pleased with Prime Buchholz and their availability to us, as remote as they are. But you know, during COVID, everybody's only a Zoom call away anyway, so it's actually been pretty useful to us. I also mentioned that Bill McCarron, the managing principal of Prime Buchholz, has joined us, and I want to thank Bill for his attendance and for everything else that Prime Buchholz brings to the table. The other shout out I'll give along the way is George Lum. George is our chief financial officer, comes to us from Triumph Bank here in town, which we're pretty excited about, where he was chief financial officer. And he is a resource to all of you. So to the extent that any of you want to talk about your asset allocations or any questions about what's going on in your investment pools, you're free to call me or George. Those are your primary resources. And I don't see any other questions. So with that, I think we'll just go ahead and save everybody 9 minutes. So thank you, everybody. We appreciate a relationship with our nonprofit partners. What you do is so important, and it's all part of our mission to help you meet your financial goals. So thanks, everybody, and let us know after this session if you have any questions. Thank you.